Hello, this is Stephan Smith with StephanSmithFX.com. It's May 2012, and I'm going to be sharing my monetary policy outlook for the Bank of Canada. The Bank of Canada is in a great position right now, with a majority of the fundamental economic statistics in its favor. It's pretty much free to do what it needs to do to be as accommodative to economic growth as possible. With inflation sitting right in the middle of the Bank of Canada's inflation target, inflation is definitely not a concern at the moment as of April 2012. The labor market in Canada is also improving just fine. During the month of April, over 50,000 people became employed month over month, and over 200,000 people became employed in April year over year. Let's not forget about retail sales. With retail sales trending upward nicely, the Bank of Canada is absolutely in a great position to do what it needs to do to be as accommodative to economic growth for Canada as possible. If inflationary pressures start to mount, the Bank of Canada can easily start tightening policies without suffering too much collateral damage, simply because their economy is moving along just fine. If inflation pressures start to weaken too much, or if the labor markets start to deteriorate, the Bank of Canada will be free to implement even more accommodative monetary policy actions to help facilitate and support economic growth for Canada without experiencing too much collateral damage, because their economy is improving just fine. Retail sales are trending upwards, employment is increasing at a good pace, inflationary pressures are stable. The Bank of Canada is just free to take whatever monetary policy actions they deem fit without many other major conflicting pressures. At the moment, I see the Bank of Canada keeping interest rates right where it is for the next couple of months, but by no means is that written in stone.